Thank you so much, Anne Richards, for joining us on day one to kick off Davos 2020. The IMF just lowering their growth forecast, not by much, 3.3% instead of 3.4% in October. What are your main risks in 2020?
Well, I think you're seeing some of the global leading indicators beginning to roll over slightly. And in a way, this is what, for example, the US, the Fed, signaled last year when it moved from a tightening stance to a loosening stance, if you like. So in a way, we shouldn't be surprised that there's been a little bit of a pullback. But what we saw from the Fed's action last year is how rapidly markets respond to that increase in liquidity that came from the loosening stance that they adopted. So I think our feeling for this year is that we're still going to be in a positive growth scenario. We're going to escape recession. But nonetheless, what we're seeing from the IMF, I think, wouldn't be a surprise to us. It is where the leading indicators are pointing.
So are we going to see a lot of volatility in the markets? We started off 2020 with quite a volatile environment, but you could argue, given the geopolitical risks that we had, the market kind of held their own.
When you've had an environment like this where asset prices have risen once again, I mean, 2019 was a terrific year for just about every asset class that you can imagine. So when you've had a year like that where you've seen, in a way, asset prices rise probably ahead of earnings, then you're always a little bit more vulnerable to some degree of volatility and correction because people are locking in profits. So I think that is going to be a little bit of a theme. We've also seen with some of the geopolitical tensions as they've waxed and waned that markets have reflected that. So it wouldn't be a surprise if we saw market setbacks at certain moments during 2020, but it doesn't feel like the pieces are in place for a substantial market correction unless there's something meaningfully different in the current shape of that global economic and indeed geopolitical picture.
And Richards, you always talked about sustainability. BlackRock also coming out last week saying they will actually not only look at sustainability but look at the companies. Basically, it's much more concrete action. How will your industry change in dealing with climate change and sustainability?
Well, you've seen across the industry really for the last, I would say, 3 or 4 years, there has been a meaningful coming together, a meaningful attempt at greater collaboration across the industry, whether it's the task force on climate-related financial disclosure or Climate Action 100. These are things where we've been signed up for a long time. We've seen the industry coming together on that, and the fact that BlackRock is now lending its weight, its very considerable weight to that, I think is really helpful and beneficial. The industry isn't going to have all of the answer to this on its own, but it's clear it has a major part to play in encouraging the businesses that we invest in to really take seriously some of the stuff that we'll be talking about this week at Davos.
But how should we deal with the passive investment? So there's such a big chunk of the markets that's in passive, and so it's difficult to actually translate that climate change awareness into those.
Well, I think as active managers, one of the tools that you always have in your kit bag ultimately is a threat of divestment. For a passive manager, BlackRock can take the decision to divest on its active funds, but for its passive funds, it's obliged to keep tracking the index. So as active managers, and us, our book is predominantly an active book, and we do have some index funds in there, obviously, but for the active funds, our view is always that your first starting point is engagement, because it's when you own the shares that you really have leverage to talk to management. You can get into the room, you can bring your views, you can really engage actively with them to push them to change in the direction that you feel they need to, and every company is different on that. So for us, I think the power of active management is really about being able to have those conversations. So we will ultimately divest in a company if we really think we're not getting the traction that we need. For us, that's a last resort. For a passive fund, they never have that tension in there. So they are always going to be holders unless the index itself changes.
Is 2020 the year of active investments coming back in force, or what needs to happen for active to really be at the forefront?
Well, it's interesting. I mean, for us, we had a strongly positive year last year in terms of net flows, and I think you've always seen into certain areas of the active industry positive flows where you've got the right capability that meets a certain client demand and where performance is good. And I think that's one of the dangers of looking at the average of companies and looking at flows in aggregate. So as I said, 2019 for us was a very positive year in terms of net flows. And by the way, not just into active equity, into active fixed income, active multi-asset as well. So, we think if you continue to deliver performance, we think if you have developed the capabilities that really meet the client need, there's still a lot of positive things in the active industry, but we've got to be live to the fact that passive is out there and will always be a threat. So we've got to do better than that.
I mean, are negative rates going to go, deeper into negative territory? And what does that mean for investments?
That's a real conundrum. I mean, we've seen, we peaked at something like 17 trillion, I think, in terms of the proportion of bond yield. It was actually returning a negative yield. That's come back a little bit since then. You've seen Sweden normalise rates to some degree since then. I don't think any of us who watch bond markets would say that we're out of the woods there yet. But what I think is interesting is that some of the central bank tool discussions around monetary policy are beginning to get really interesting. I know somebody had a great piece of analysis out recently about whether dual rates was something in terms of dual fixed versus dual deposit versus lending rates would actually be an additional tool, and that might reshape things considerably. So I think there's some real imaginative work beginning to go on in terms of monetary policy, which might help us in some of that. But nonetheless, negative rates are a very depressing effect on consumer behaviour and on the economy at large, and we do want to get beyond the point where negative rates have become a reality for quite a few markets around the world.
And what do your clients ask of Fidelity right now?
Well, there's a lot around, as we talked about in climate, ESG, that whole engagement piece, and we're kind of continuing to see really clear. One of my fund managers actually said a few weeks ago that in the entirety of his career, he'd had something like 3 or 4 questions about ESG when he talked to clients until last year, where he didn't have a single meeting where ESG was not raised. And it's fascinating to see that flip. So that's going to be a really a strong theme, I think, for some time to come. We're seeing more demand for thematic funds, where people are looking not just for an asset class building, a European equity or a UK equity or a Japanese equity building block, but for things which really touch specific themes. It could be around climate. Water and waste has been another one that's been really live in the last year or so. So that's another area. And then finally, how you can put the building blocks together to deliver something that produces some level of yield without too much volatility, given the fact that bond markets, which used to provide that, don't provide that anymore. And that's a constant demand really right around the world.
But do you see, because of negative rates, people actually not wanting to be invested, going to cash?
No, because actually in cash you get so little return now that that's regarded as being a risk in its own right in a number of countries. Here in Switzerland, for example, it's a real challenge. No, I think one of the areas where we see clients beginning to look more closely again is in Asia, emerging markets more generally, which is a part of the world where you do get some level of positive real yield, where people can see there's an underlying growth characteristic in the market. So we're definitely seeing people look a little bit further afield in that quest for yield. But as with all of these things, none of them are risk-free. It's just different risks.
Where do you see the biggest risk coming from?
In 2020, I think there's sort of 2 things which I'd sort of call out. The first is just there's a risk that markets have moved ahead of both the underlying economy and company earnings, and particularly the US market's been pretty concentrated in the tech sector, so you've not had a broad market. So we are vulnerable at a headline level to setbacks in a few individual stocks. So I think there's an element there where there's that gapping out, which is a potential risk. I think the more broad one, which is not specific to 2020, but we do see when we look across the landscape of regulation that liquidity is becoming a bit stickier, that we're seeing capital being allocated and being almost trapped within individual legal entities, within individual parts of businesses, which means we're getting this odd spike. Repo markets, currency markets have seen these odd bouts of volatility just because the capital couldn't move around, the liquidity couldn't move around the system quite as rapidly as it needed to. And so you then see some strange movements in markets, and I think that remains a risk.
But is it something that could be sinister? Or if you look at the repo market, they say, it was something a little bit mechanic, which the Fed has now fixed.
I think what we've... And again, when you talk privately to some central bankers, they would express probably more concern about this than they do publicly. And I think it's because nobody is quite sure if a series of idiosyncratic events, of which there have been more in the last 12 to 18 months than there have been previously, are related or not. And are they evidence of too much stickiness in the system, or is it just happenstance? Are they just a bunch of unconnected events? I think because we know what it feels like when the market can't find the liquidity it needs at the right moment, and given that we've had some larger geopolitical events, for example, the US-China trade tensions, perhaps now happily resolved, but which have impeded some of that flow of capital. I think that just means we have to be really live to, maybe it isn't idiosyncratic, maybe there's something a bit more systemic, and perhaps we have to be ready to move very quickly if something does happen.